and welcome to Macros with Mythili, our weekly program where we take a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at an issue that's been in the news intermittently during the past 2 months. We're going to look at the provisions relating to the government securities market and the Reserve Bank of India in the finance bill presented by the FM as part of the Union Budget in February. Though temporarily on the back burner following the government's decision to drop these in the final bill, it's only a matter of time because they're back on the front burner. So what's the controversy all about? To help us join the dots, we have with us some of the best brains on the subject. Dr. C Rangarajan, former Governor Reserve Bank of India, Dr. Subir Gokarn, former Deputy Governor Reserve Bank of India, and N.S. Venkatesh, Executive Director IDBI and Chairman FIMDA. Welcome to the show, gentlemen. Dr. Rangarajan, if I may start with you, as somebody who's been there, done that, I was also, of course, Subir. I was wondering, the way the government has introduced these clauses as part of the finance bill, there are two issues over here. One is, of course, of form and the other is of substance. So if I can start with the first, the issue of form. Was it correct of the government really to have issued these brought these clauses in through the finance bill rather than bringing a separate amendment to the Reserve Bank of India Act? That would have been a more open, more direct thing to do. So was there some amount of element of subterfuge involved in the whole thing?
Well, it has not been handled well, but the Finance Act normally includes amendments to other acts also. It is not as if that the amendments to the other acts are not introduced through the finance bill. But in this case, it so happens that the amendments that are proposed or contemplated had very significant changes, and therefore it would have been better to discuss them separately under an amendment to the original act rather than being put it in the finance bill. But having said that, my own view is that in the past also amendments to the various other acts have been done through the finance bill.
Oh yes, you're absolutely right. Very often, in fact, amendments to other bills have been done through the finance bill. But Subir, here I think the issue really was not just of inclusion of these clauses, but also for the fact that the budget speech was completely silent. In fact, so much so that when the governor was asked about it, he said they didn't even find mention in the budget speech. Was that a little odd, or are we journalists always seeing conspiracies everywhere? Subir?
I think form is clearly an important part of this, particularly the issue raised in Parliament about the need to have this set of amendments actually passed by the Rajya Sabha as well, as opposed to the finance bill, which is essentially only a Lok Sabha legislation. So that's one set of issues, and I really can't, I don't have the expertise on this process to be able to comment anymore. But I think the bigger issue and the discussion that is has gone on, of course, for a while, is the merit of the transition itself and the conditions under which it's going to make a difference, is going to be an improvement. Much of the debate has been focused on the conflict of interest between monetary policy and the debt management function. The argument being that if debt management is a concern, then interest rate actions for monetary policy purposes may be conditioned by the concern that the debt manager would have in terms of keeping borrowing costs low or high, and that would compromise the focus, the emphasis on inflation management. On the other side of the debate is the fact that the government owns much of the banking system, and that if you do have a debt management organization, a debt management agency that is under the control of the finance ministry, there is a sort of fiscal conflict of interest where banks can be pressurized. They can of course be pressurized even now, but more so banks can be pressurized to increase their holdings of government securities at a time when the government needs to borrow more money. So there is a monetary conflict, there is a fiscal conflict, and I think the judgment has to be made on which one is the worst one. Now, my solution to this, my proposal in this regard, is that if the function, and I have no particular issue with the function being taken away from the Reserve Bank and put into an independent, I think an independent agency is very important. That's where the process seems to be heading. The stumbling block to me is the SLR, the mandate that banks hold government securities. If you want the debt management function to perform efficiently, I think the SLR is a millstone. It is a bottleneck, and we have to move away from this mandate that banks are saddled with to hold government securities and at a fixed proportion to their liabilities. So, if you are talking about reform overall, we have to look at the kind of conditions, the ecosystem within which an external or independent debt management agency can do its job as an investment banker to the government, minimizing cost of borrowing, which is what its mandate should be, and then looking at the market to place debt without this this sort of what you might call a freebie, a guaranteed customer through the SLR. So, I think we have to look at this in totality and not just in bits and pieces. The whole system has to respond to or be conditioned to this change.
Oh, absolutely, yes. So, we will come to the details of the separation of the PDMA and the amendments to the clauses in the RBI Act a little later. But if I can turn to Venkat now. Venkat, were you surprised at the way in which this was done? And did you, all of you in the market at least, do you see this as yet another attempt by the government to somehow clip the RBI's wings, as it were?
No, honestly, we believe that more discussions could have happened on this particular amendment that they were proposing from the market side, because the markets are functioning efficiently at this particular point of time, with RBI playing its role as the debt manager for the government of India in a very efficient manner. And to think of moving it out of this particular system and putting it into a new system, we believe there should be a larger amount of public debate on that, so that at least the market is well prepared for that. Otherwise, there could be market disruptions which could then lead to other sort of issues, like the cost of borrowing for the government itself going up, and then it will also have a cascading effect on the other costs in the economy. So we definitely felt that there could have been much more wider discussion and debate when the Reserve Bank as a central bank has been managing the debt market in a very, very efficient manner.
Okay, so there is a need for wider debate, and that's what we hope this program is going to do, further the cause of greater debate. But I'm afraid on that note, we have to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the recent amendments in the Finance Bill, altering the position in the original Finance Bill on government securities market and the RBI's role in regulating the government securities market. Dr. Rangarajan, if I can start once again with you. Venkat spoke about the need for greater debate. But the point is, this debate has been going on for a very long time, because right from the time of the first Tarapur Committee report, there has been talk of shifting the PDMA, the public debt management, out of the Reserve Bank of India. So how long can we have this debate? Is there a case for saying how long can we have this debate? Now is the time to move, or should we say enough is enough and let's shift the public debt function out of Reserve Bank of India?
I think the discussions have gone on for a long time, and the time has come to take a decision. But let me say that the function that the Reserve Bank of India was performing or is continuing to perform is a kind of an agency function. The debt is that of the government of India. The debt, it has to raise it, and it has to redeem it, repay it, and so on. And therefore, this function was, so to say, entrusted to the Reserve Bank of India by the government. Now, for several decades, for more than 5 decades, it worked to the advantage of both the government and the Reserve Bank. The government wanted to raise the loan at well below the market rates, and the Reserve Bank of India cooperated by raising the SLR higher and higher. But in this particular process, I do believe the autonomy of or the independence of monetary policy was lost. And but things have changed with the phasing out of the ad hoc treasury bills, and with the FRBM Act not allowing the Reserve Bank of India to come into the primary market. The conflict of interest aspect has come down a bit, but the conflict of interest, in my opinion, continues to exist. And I do not believe that the conduct of monetary policy is enhanced by the Reserve Bank of India having the public debt management function under its roof. So what is really required is whether the government is in a position to be able to organize an agency which is efficient. Venkatesh pointed out about the cost and the disruption to the market. Therefore, the question is all whether the government is already ready to launch this. There is a considerable amount of expertise available within the Reserve Bank, and therefore either this independent agency can even be entrusted to the Reserve Bank, or the officers of the Reserve Bank should be deputed to this agency so that the efficiency with which the functions can be performed must not be lost. Therefore, I believe that I also want to comment, the statutory liquidity ratio is a stumbling block, not necessarily in creating a separate public debt management agency. Now the statutory liquidity ratio has been raised or has been lowered so much. Now it is almost like prudential regulation. It is no longer the kind of ratio it existed. Please remember, in 1990 we had 37% as the statutory liquidity ratio. We have come down a long way, and therefore in that sense it does not directly come in the way. Let us treat it as a prudential regulation. Therefore it is possible for the independent agency to function, but the expertise is important, and the expertise at the present moment is in the Reserve Bank. It should be made use of in a meaningful way.
Okay. Subir, Dr. Rangarajan raised three very relevant points. He said the agency should be independent. The question is, can government really ensure independence? We've seen what they've done with regulatory agencies, particularly when you talk about the power sector or any sector. Independence is really only on paper. Secondly, he talked about autonomy of monetary policy. But post the global financial crisis, is there any real autonomy for any monetary authority anywhere in the world? And third, he talked about SLR, something that you also mentioned. Now, SLR at 21.5 is way below what it was 37% earlier. But is it not significantly high in order to impact the government securities market? How do you react to all these 3 points that Dr. Rangarajan has raised in support of shifting PDMA out of the Reserve Bank of India?
Well, I think the issue of independence, as you said, is a broader issue of government defining its relationship with agencies that are most effective when they are both actually independent and perceived to be independent. That's an evolving kind of a context. I don't think we can make a judgment about something not being independent forever. As you said, there are regulators whose independence has been questioned. There are regulators whose independence is taken as taken for granted. So I think it's a matter of finding the right niche, if you will, for an agency. As I said, the technical argument for it being inside the bank or outside the bank to me is really not a critical argument, because it can be done, the function can be performed efficiently elsewhere. Dr. Rangarajan's point about resources and expertise, I think, is very important. That the fact that the people who have been doing this are in the Reserve Bank, does it mean that they have to stay in the Reserve Bank, or can they be transferred as experts, as people with embodied knowledge into an outside agency? But that is a logistic issue which needs to be worked out. So again, I'm saying that if you want to create a system that's going to work, then you have to have all the components in place, and that includes people and expertise which may come from the Reserve Bank, which may come from markets. There's no, I don't think it's a given that the expertise only exists within the Reserve Bank. There may be expertise outside. People like Mr. Venkatesh, who've been working in markets for decades. How do we bring these people in? Can an independent agency outside the Reserve Bank facilitate this rather than people being, joining the Reserve Bank as experts? So there are these issues. I think there are two sides to this argument. On the SLR, I think the critical problem here with SLR is not the quantum. I think the quantum is way too high in any case, but it is the exemption from mark to market. If you want a liquid asset, if liquidity is your objective, and note that it is a statutory liquidity ratio, the asset has to be mark to market. This is simple prudence. Under the Basel III, the liquidity coverage ratios that are being discussed also basically cover assets or include assets which are mark to market on a relatively frequent basis. So it's not liquid unless you know what the value that you're going to realize in case you need to. So I think the SLR is, as a framework now, with the exemption on mark to market, it is obsolete. We have to move away from it. We have to introduce mark to market. Over the last 2 or 3 years, 2 years, the number has come down from 23 to 21.5. But that's very slow progress. I think we have to look at a much more radical reform of the SLR. And that is, to me, part of the overall larger objective of debt management and developing a debt market. Both of these are sort of two sides of the same coin. And I think we have to look at the critical issue there, which is unlocking this sort of constraint on the huge percentage of outstanding government securities that are sitting on bank books without requiring mark-to-market. That to me is the biggest deterrent to the development of debt markets. I think that's what we need to address.
Absolutely. The biggest deterrent to the debt market development is really this exemption from mark-to-market. But Venkatesh, in fact, the argument for shifting management and regulation of public debt to SEBI is precisely this, that all securities and transactions in the securities market should be regulated by SEBI. But the point is the government securities market, particularly in the absence of mark-to-market, is it really a market at all? And is that not also linked with the government's huge need for borrowing? If the government's fiscal deficit were to come down, there wouldn't be the need to have such a high SLR. So how do you as a market player see this? Is the market for government securities a genuine market at all in today's circumstances?
I believe that it is a genuine market for the simple reason that the daily turnover is more than say around 30,000 crore. So definitely it's a genuine market. We have seen this market moving from, let us say, a total outstanding issuance of somewhere around less than 10,000 crore in 1990s to now at least around gross issuance of around 6 lakh crore in this year. So to that much extent, the market has really rebounded and grown at a very rapid pace, which also goes to show that maybe the fiscal deficit is higher, and so the quantum of borrowing of the government of India is high. But having said that, I would say that the market is liquid, but it is liquid in very few securities. So the consolidation of securities, those sort of things needs to happen, which I think the central bank in consultation with the government of India is trying to do that because the balance sheet of the government also needs to bear the premiums when the consolidation happens. So to that much extent, I think they are doing a job in a very, very calibrated manner. I agree with the point of Dr. Gokarn relating to the reduction in SLR. I think they are over from 38.5% to come down to 21.5%, and then the longer term is 15% as per Narasimhan Committee report itself. So I think we will reach that 15%. Then it becomes a pure liquidity tool. And to that much extent, the liquid coverage ratios which are there in Basel will ensure that we move to that 15% sooner than later. On the mark-to-market issue, I believe that with the IFRS coming into play, at least from 2018, all the banks will need to come to the IFRS. And if you are looking at it from that angle, then definitely you will see that the HTM will also come to the mark-to-market. So to that much extent, a vibrant debt market where more trades, maybe more securities becoming liquid, all those things will come into place. But looking at the current question of maybe taking the public debt management and putting it into an independent authority and then giving it to SEBI for the regulation, I personally believe that even in the outside world, that is the developed markets, the SEC doesn't regulate their government bonds. The regulation of the government bonds maybe remains with, let us say, the independent authority, the ministry, and the central bank. It doesn't go to securities market regulator where essentially the equities and the corporate bonds are done. So maybe we need to look at it as to how to move it if at all the government feels it has to be moved. But I personally believe that the job that is being done by the Reserve Bank of India at this current juncture doesn't warrant it to be taken out of the regulatory framework. They can be the regulator. The PDMA can be maybe a issuer of the bond, that sort of thing.
Sure. We'll come to the aspect of regulation in our next segment, but I'm afraid at this point we'll have to slip into a very short break. So Venkatesh, I'll interrupt you there, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the amendments to the finance bill that reasserted the Reserve Bank of India's control, quote unquote, over the government securities market. Dr. Rangarajan, just before the break, Venkatesh was talking about how even if the public debt function were to be shifted out, regulation should remain with the Reserve Bank of India. And that brings us to the second part of the changes in the Finance Act, basically saying that as far as repo, reverse repo powers are concerned, those powers should remain with the Reserve Bank of India because they are critical to liquidity management in the system. How do you view this issue of how repo, reverse repo powers should remain with the Reserve Bank of India if they are to have any kind of control over liquidity and hence over price stability?
First of all, my understanding, and I have checked with legal people, that the proposed amendment does not take away the powers or does not in any way interfere with the repo operations of the Reserve Bank of India. But the larger issue still remains. that who is the regulator of the government securities market. In one sense, SEBI or its corresponding authority in other countries is the regulator of the markets, and government securities is a market. Therefore, what is required in my view is a joint responsibility between the Reserve Bank of India and the market regulator SEBI, because the market regulator may have some general rules and principles which apply to market participants across all kinds of markets. And if there are such general rules, I think they should apply to the participants in the government securities market also. But given the fact that the conduct of monetary policy is closely regulated or closely related to the operations of the government securities market, I still feel that the Reserve Bank of India has a special role with respect to the government securities market. Therefore, what I would propose is that the set some general rules relating to the market participation or the market participants as dictated by SEBI should apply, but specific rules relating to the government securities regulation must lie with the Reserve Bank. I think this combination is what is required, and I do believe that there is something like this going on with respect to the foreign exchange futures market. I think there is a very clear understanding between RBI and SEBI on this. Therefore, we should move towards that kind of a situation in which both regulators will have some role to play, but the dominant role will that of the RBI.
Subir, would you agree with Dr. Rangarajan's suggestion that in the case of government securities market, the dominant role should remain that of the Reserve Bank of India, given its link with monetary policy?
I don't know if I would call it a dominant role. I think he's laid out the delineation between the conduct of business kind of regulation which the market regulator should be carrying out, and that's very clear that anything that involves trade in relation to margins, who can participate, settlement, counterparty, all of those are really the domain of the market regulator. And anything that relates to prudence and financial stability, which is the way in which securities are treated, the way in which securities are valued, the provisioning, the risk aspects of the portfolio, those clearly, given that they emerge from financial stability considerations, those clearly remain with the central bank. So I don't think it's a matter of dominance or a subordination as much as a clear recognition of the motivation for regulation. And as long as we have that understanding, I think the interface, the coordination between the two doesn't really pose any problems.
Venkatesh, as a market player, how would you look at those suggestions that even if those clauses were to remain in the finance bill, suppose the finance minister was to come again with the same kind of recommendations in the next year's budget, how would you regard that?
See, essentially the government securities market globally also is not an exchange traded market. It is actually an OTC market, and here at least in India we have moved it to a clear, really anonymous trading platform called the India's Home, run by Clearing Corporation of India, which is mainly owned by the banks themselves and regulated by the Reserve Bank of India, and it is working so efficiently. The thought process is that listing it onto an exchange may bring a little bit of retail participation, but retail participation in the government securities market is not that high. Even globally it is not that, a very great success. So do we want to just do a regulation for a regulation's sake, or do you want to say that this market is actually functioning efficiently? It is not broke. Why do we want to fix it at this particular point of time? The second thing is, okay, on the regulation, essentially the repo and reverse repo, that whatever we were talking about in the amendment, if the repo and reverse repo regulation goes to the SEBI and RBI has to manage the liquidity measure using the repo and reverse repo as part of its monetary policy, how does it work? So those sort of clarificatory things have to happen. So any change will have its own sets of uncertainties coming into the market. So it should be better that it should be discussed and maybe clarified sufficiently in advance with a transition path put in place. It should not be immediate and abrupt so that the market then goes into a very disruptive mode.
Dr. Rangarajan, we are running out of time, but I'd like to give you the last word. And before I do that, I'd like to quote Charles Goodhart, a member of the UK's Monetary Policy Committee. He said, When the public sector of a country becomes so indebted that its fiscal sustainability is at risk, then monetary policy has perforce to be closely integrated with debt management and fiscal policy. Given that, how do you see the recent changes?
Well, I don't think the financial crisis of 2008 has any relationship to this. After all, the origin and the causes were all very, very different. I don't think we need to draw any lesson, there is any lesson from the crisis as far as this is concerned. Basically, it is a question of the integrity of monetary policy, how well and how efficiently it can be performed, and therefore, if certain changes are called for, it should be done. But basically, one is really talking about the normal functions of raising the loan from the market and repaying it and so on and so forth. All this can be done by any agency. I think there is really no problem. In fact, the Reserve Bank of India has not been doing any management in that sense, in the sense of changing the maturity structure, buying short, selling long, and all that sort of thing. Basically, it is also performing the agency function, and it can be performed by anybody.
Well, I'm afraid that brings us to the end of the discussion in Macros and Mythili, wherein we've talked about the recent proposed changes in the finance bill and what it means for the government securities market and the Reserve Bank of India. Somewhat surprisingly, both Dr. Rangarajan and Subir are open to the idea of the changes proposed, whereas Venkat, as a player in the market, feels the RBI has been doing a good enough job and there's no reason whatsoever to rock the boat, at least not without further discussions. Thank you so much, Dr. Rangarajan, Subir, as well as Venkat, for joining us. Thank you also for watching the program, but we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.